the U.S. equity market is pretty overvalued. The U.S., we're the most powerful country in the world. We're the leading economic power in the world because of confidence in our institutions. And when things happen that underlie that confidence, it could bode poorly for the United States as a whole. So it's a potentially very big.
How should investors navigate changing policy, uncertainty surrounding trade, as well as fiscal policy? How should investors navigate volatility surrounding geopolitical developments? We'll be talking about asset allocation and portfolio management with our next guest, Hal Ratner, Global Head of Research at Morningstar Investment Management. We'll be talking about his views on proper diversification and the asset allocation that he prefers right now. Welcome to the show, Hal. It's good to see you. I'm a big fan of Morningstar. I've been reading the reports since I was a wee lad.
Great. Thanks. We appreciate that. And thanks for the invitation. So I think I wanted to start. Go ahead.
Yes. No, please.
I think I wanted to start off by just saying that the primary focus of the group that I work with, or my team, is really revolves around retirement investing and using what's called an automated portfolio construction algorithm and an online algorithm that's designed to allocate funds for individuals who are seeking to maximize their retirement income. So for the most part, what we're looking at when we do our modeling is long-term estimates of asset allocation, of asset classes, how they're going to perform, how they'll behave together. And while we do look at what's currently going on in the market, that's not actually, it's not usually something that we give a lot of credence to, again, because we're looking at investment horizons of like 40 years, 30 years in some cases. Now, that said, in terms of, how I view the market right now, is I think and I'm speaking, kind of for myself and kind of for Morningstar as a whole, but mostly probably for myself. Not that my views differ from Morningstar's that much, but this is me talking and I'm Morningstar. So I think by any traditional measure, the U.S. equity market is pretty overvalued. There's a lot of confusion, and I think there's a lot of there's reasons to be concerned because I do think the underlying economy is not doing terribly well right now. We saw the employment numbers come out recently. They were quite poor. There's a lot of confusion coming out of the Trump administration right now in terms of, what direction are we going to go, particularly around tariffs. It looks pretty negative at this point, but Trump does have the tendency to sort of change position on things relatively swiftly. That is good. I mean, the taco, Trump always chickens out, is meant to be an insult, but it's actually kind of a good thing because it implies that he's not necessarily focused in or wed to some particular view that has its negatives and its positives. But the positives, if things really start going south, there's some probability we'll see a relaxation, I think, of some of those tariffs, or at least a more intelligent implementation than what we're looking at right now. That confusion is a real problem, right? Because if you're, and I know this is, if you're an employer, you don't know what to do about hiring necessarily. You don't know where inflation is going. To kind of dovetail with another piece that David, you had mentioned in our communications, his interference with Bureau of Labor Statistics and the Fed are very potentially negative things for the market. So,
as an asset allocator, whenever you see weakness in the economy, like you mentioned, payroll numbers, for example, and then you see the markets continuing to grind higher, in other words, somewhat of a disconnect, what do you do with that?
Well, I think that you kind of stick in cases like, so most asset allocators like us have something called sort of a policy portfolio. So this means that in the event that you have no particular view on the market, how do you position yourself? And so in this particular market, we would recommend essentially doing that. It's really difficult, again, to kind of predict where things are going right now. The market, again, does seem to be overvalued, but it also seems to be that people's risk appetites may be a little bit different than they've been in the past. And again, given all I think the lack of clarity right now in building out a coherent macroeconomic picture right now, the view is to kind of stay where you are and not move, in anywhere, and not to take any strong bets at this point, particularly for our investors who, again, have very long horizons.
I do want to get to exactly what your asset allocation is in just 1 minute, but I want to first address this interesting article I read in the Financial Times this morning. It may have to do with what you're talking about in regards to your long-term outlook. I'll just read these two paragraphs.
Yeah, sure.
So there are a few better scholars to put AI in historical perspective than Carlota Perez, author of Technological Revolutions of Financial Capital, The Dynamics of Bubbles and Golden Ages. In her book, Perez identifies 5 great technological revolutions: the Industrial Revolution of the 18th century, the Steam, Coal, and Railway Revolution of the 1830s, the Steel and Heavy Engineering Revolution of the 1870s, the Mass Production Age in the early 20th century, and the Information Technology Revolution beginning in the 1970s. The author sees AI as an extension of that 5th technological revolution happening now. She also argues that these revolutions follow a fairly predictable cycle. An initial installation phase results in lots of creative destruction and social disruption as industries and regions are upended. This is normally accompanied by overinvestment, financial mania, and stock market bubbles. I bring this up because she identifies long-term cycles over the course of the last 200 years. Do you agree with the last statement that we're currently perhaps seeing signs of overinvestment, financial mania, and stock market bubbles that may last years during this 5th technological revolution that the author has quoted?
Yeah. I mean, I think that's a reasonable assertion. I think one thing that I would say, these are all good points, is I do think the AI revolution is actually more profound than a lot of these other revolutions that she mentioned. So a lot of the things like the Industrial Revolution really resulted in things like changing the means of production, right, and shrinking time and space through improvements in travel and efficiency and things like that. So there were really changes that impacted how we dealt with. I don't want to necessarily get too philosophical here, but I do think this is important. How we dealt with the terrestrial, right, and they were very disruptive. And the whole kind of Schumpeter concept of creative destruction, I think, is well taken in this case. I do think with AI, the change is that we're talking about a way that people perceive all aspects of reality. And there are people right now that simply live. You can live entirely in your house and just be on the internet all day. And if the information flow and the way that you think about things is entirely mediated by these algorithms out there, many of which are not, they're controlling themselves, you could begin to get somewhat disconnected from the terrestrial world. And the more people, I think, are, part of this, and we all are, right? I mean, I was using AI this morning to do some research. The more it kind of changes how we work and how we all how we think about the labor market, how we think about politics, how we think about the economy as a whole. So I think it's absolutely profound. And the other thing I would mention too is you do see through AI and things like ChatGPT, people sort of outsourcing their intellect to these engines, right? So you may remember when you were in school, if you were writing a research paper or doing something, you'd use the internet to find literature that was relevant to the subject, but then you'd kind of go to, an economic journal, right, to find an article that was written on that subject. Now people just kind of go to ChatGPT, you get an abstract of what's going on, and you kind of take that information away. And I think that process of not having to do the work to get that information, and search for it, may have some impact on how people think about things and also what their retention of knowledge is. This may be going in a very different direction than you intended, but I think it's very profound.
Well, just on, I like your line of thought, Hal. So just on that. So given that your asset allocation approach is multi-decade and focuses on the end game, which is retirement, how do you think this AI revolution that's currently happening is going to affect people entering retirement in the next coming decades? How would it change, fundamentally change society that is getting older in the next coming next coming decades? And given these changes, how would you distribute your asset allocation?
Well, I don't know that there are any at this point clear enough signals to say that you would change, what we would change what our asset allocation is. And again, our asset allocation changes as people move through the retirement space. So the way our product worked and the way typically retirement advisors work is there's something called a glide path. The glide path it says an investor is X years old, 30 years old, they should have asset allocation A. As they move toward retirement, that asset allocation should change. And our model's a little bit more sophisticated than that, in that we take into account a bunch of factors that would lead to an ideal asset allocation, such as how much money does somebody have? How much do they have saved? How old are they? What is their gender? Do they have outside assets? All these other factors come in to determine what that asset allocation should be. And then in terms of, I think, linking this back to AI or just technology, our entire business is based on the fact that the internet exists and you can deploy these models in real time. So I may not be exactly answering your question, but it's absolutely crucial to how we do things. So a retiree and retirement investor, an individual in a 401k plan doesn't need to necessarily sit down with an advisor to get some sort of modicum of investment advice about how they should be investing. They can go literally to a URL that, input the proper information, or we can grab that information from their employer and then build a model of how they should actually invest. And I think going forward, there's going to be more and more of that sort of investing and that information sharing online. It's a lot more efficient than, the way it was done, let's say 15, 20 years ago.
What I was wondering, if there are concrete lifestyle changes that we can observe that may influence the types of stocks or sectors that you may be overweight. For example, if let's say a few decades ago, primarily you would be looking at maybe consumer discretionaries or staples as long-term plays, because everybody needs, consumer staples even into their old age. Nowadays, people Uber Eats their food. Maybe I don't remember the last time I bought groceries. I really don't. A lot of my friends as well. We're becoming more and more reliant on big tech. So perhaps that allocation would change for this current generation versus a few decades ago.
I mean, one thing I would certainly look at would be things relating to longevity risk, right? So we have more people living longer right now. They're declining. I mean, the amount of people, like, going forward, we're looking at an environment where people are getting, they're living for much longer periods of times, but they're also very much in need of medical assistance and long-term care and assisted living and things of that nature. Now, that's pretty granular, but I do think that that's something that's going to have a meaningful impact on, how one might want to invest their money. So thinking in terms of an aging population, and a population that lives for a really long time and needs the things that people who are old and enfeebled, need, is I think that's a theme that is undeniable at this point. I think that's a real trend.
And what about the trend that more and more people are going to become dependents in the future? For example, the dependency ratio of most developed countries is going to become closer to 1. There's going to be, for every working person, there's going to be a non-working age person. So the assumption here is that overall consumer spending may go down. Have you considered that, and whether or not overall consumer spending in the future may change, and ultimately what that does for you?
Yeah, I mean, that seems plausible to me. I don't know that I have a strong opinion on it, but yeah, right. I mean, if more money is going away from discretionary spending and more toward, non-discretionary spending, which again would be supporting, people who need additional care because of their age and their frailty, that really could make a difference. I agree.
All right. So what's in your model right now? Let's start with large caps. How much of the allocation is given to the S&P, for example?
So our model on the U.S. side is pretty much close to market weighted. We have a slight value bias that I would say it's almost structural. It started to disappear over the past couple of years or so, but we definitely do have kind of a bias there as well. And we also have, we've had up until recently, a bias towards small caps as well. Internationally, we're market weighted. We have about 30% of, about 33% of all of our equity is in foreign stocks. So that would be the EFA and the emerging market index as well. We do have allocations on the bond side. It's also, it's also fairly close to what you would say would be sort of an ag type allocation with biases toward tips, particularly short tips. These are good vehicles to defease, expenses and retirement. We did have an allocation to long tips that we took out of the model because long tips tend to respond more toward, they're very volatile and they respond more to changes in rates. They have very long durations as opposed to short tips. And we have allocations to non-dollar bonds as well with a slight bias toward, non-US bonds with a slight bias toward emerging market bonds as well. So, and these are fairly structural. They move around a little bit from one period to the next. We have a commodity futures allocation as well, which is probably about 5% of equity on average, and that kind of moves up and down depending on our view on how things are going to play out. Let's say over the next 5 years.
How frequently do you adjust your allocation per year?
We do. Yeah, we do it on an annual. We only do it annually, and we do it with a 5 to 20 year horizon. We will make changes if something really big happens in the market, and certainly if something structural would happen. So I don't know, like the euro is goes out of existence, and we revert to native like country specific currencies. But it would have to be some really major event for us to go back and revisit everything.
All right, and generally speaking, what criteria do you look at or consider when making asset allocation changes on an annual basis?
Well, actually, one of the things is we don't want to move the allocations around too much from one year to the other. There are technical reasons for that, but it's also the case that, again, unless there's really, really strong convictions, we don't want to change things around that much. We're managing or advising on about $150 billion of assets, and they're small pools of assets. So there's definitely an interest in not moving portfolios around all that much. But the things we look at is current valuations, and we have a forecast model that goes out 20 years. And depending on the, what that forecast model looks like, we'll make changes to our to the asset allocation model. But again, it's strategic. It's something that I would refer to as unconditional, which means while we are taking into account current information, the amount of impact that has on the portfolios is actually relatively small.
Okay, how would you describe this strategy versus simply a buy and hold of large caps or a 60-40 portfolio where you have large caps versus bonds and you just hold that for multiple decades? I mean, what are the advantages of your strategy versus something that's just, yeah?
Our model changes as a function of where somebody is in the investment cycle. Okay, so for example, here I'll give you a good example. So again, if you're 30 years old and you have a really long horizon, and I'm not going to take into account like any specific issues you may have with your investments, like you have a large position, let's say in company stock, or assets you can't hold, which would have an impact on the solution. Let's just say that doesn't exist. By and large, you're going to have a really heavy equity portfolio with a bias, pretty well diversified across the board, and a bias toward riskier assets, a bias toward emerging markets debt, a bias toward commodity futures and smaller cap stocks as well. And if we're talking about private equity, it would have a bias toward, like a big bias comparatively toward private equity. These are assets that have, long-term payoff potential. It makes sense for younger people to hold them. Okay. As you get older, we begin reducing the amount of risk assets you have. And we also, the easiest way to think about that is you end up getting more bonds relative to stocks. But it's also the case that as you get closer to retirement, we change the asset allocation such that it aligns with the expected consumption basket of the typical retiree. So you move more into dollar-denominated assets, and you move more into kind of larger cap stocks, and you move particularly away from having much exposure to any kind of like currency risk that would be part of the portfolio. And so the model we actually use is is one essentially where we're trying to align the asset allocation with the expected consumption schedule and the composition of that consumption of the individual who's in retirement. If you have a very long retirement, I mean, a very long horizon until you retire, that doesn't really matter. And the portfolios kind of look like, they're sort of meant to maximize risk and return in a standard way. But as you get closer to retirement, the portfolios converge on what's called a liability-driven model, in which your optimization of the portfolios, instead of optimizing risk and return or other aspects of the expected probability distribution, you're actually trying to minimize that risk between what the liability composition of the liabilities are. And again, this is the consumption of people who are in the retirement space versus what the portfolio actually looks like.
At what point in somebody's... Yeah, please go ahead.
I can, if that's unclear or it doesn't make sense, I'm more than happy to elaborate.
Well, I was just wondering, at what point in somebody's life should they look into this kind of a portfolio? Like, when should we start? Because you mentioned it changes throughout somebody's life closer to retirement.
I think for sure, if you're not using a formal model, like when the drawdown stage, that idea of aligning the portfolio to some degree with your consumption schedule, I think is a good thing. People kind of naturally do it, and then they naturally think of, you want to decrease risk in the portfolio, but also ensuring again that that the amount of exposure you have to assets that are not necessarily representative in your consumption basket is a good thing to do. So again, kind of minimizing currency risk is a good thing to do. Minimizing exposure to small cap stocks and that kind of thing can be helpful.
Okay, so just going back to my question, at what point should we start looking into planning for retirement? So is it 25, 30 years old, 35, 40? Is there a rule here?
Yeah, I mean, you should. The idea is you should start thinking about retirement as soon as possible. That doesn't mean you don't necessarily need an LDI type portfolio, but the way that we look at it is that, the sooner you start planning for retirement, and that includes things like how much are you saving and what are you investing in and what might you be investing in going forward is super important.
Right. So is there a guideline for how much of our income should be set aside for savings and investments? So let's use a nice round number. Let's say I'm pulling in $100,000 a year. That's my pre-tax salary. So I'm, spending on housing, food, clothing, basic necessities. Then let's allocate some of that to a portfolio like yours. Like, roughly what's the percentage we should be looking at here?
I would say something along the lines of overall, maybe something around 15%. Now, I'm including in there, if you're if you have a 401k plan, they typically have a company match. So the amount that's actually coming out of pocket would be less than that. But I think that probably makes the most sense. And the earlier, again, you start investing, the greater probability you have of, meeting that goal, and even have the possibility, if you're particularly successful, of reducing your savings rate as you approach retirement.
What is your view on the 401k plan? Should employees actually subscribe to that plan, or should they just opt out and manage their own money, or hire a manager to manage their money, or buy a fund outside of a 401k plan?
Well, I think that most employees should invest in their 401k plan, if only because they're getting additional contributions to that plan from their from their employer. I would say that, if there are target date funds in the plan, again, these are professionally managed multi-asset class vehicles. That's definitely the way to go. And if you have a managed account type program like the one that we have, that's also definitely the way to go. I think there are very few investors who, are comfortable actually constructing their own portfolios using the investments that are available in their 401k. So that's my recommendation. I also think if you have a 401k plan, I think going to an advisor to pay them to manage your retirement money, unless the plan is particularly poor, I'm not, and you don't have again any managed component of that plan, like no target date fund and no managed account process. Then I'm not sure that's a really great use of one's money, just if that's your only goal.
I want to turn our attention now to some recent news surrounding changes to policy. So this is from Morningstar. You wrote this article, actually. Private market investing coming to your 401k. Here's what Trump's executive order can mean for investors. I'll just sum up what happened here. So there was a recent executive order that allowed the SEC, Department of Labor, and the Treasury to work on a framework that would allow for the inclusion of private market investments in defined contribution plans. Further down, it also allows the inclusion of cryptos in 401ks. Are we going to see immediate changes to our 401k because of this new order?
No, it's really unlikely. You will see changes. I think in the long run, these what the Trump administration is referring to as alternative assets are going to make it into a lot of plans, and I think that's a good thing, right? But they're going to be mediated by some sort of advisor. So if there's a crypto ETF or crypto fund in your plan, the likelihood of you getting direct access to that is at this point seems pretty much impossible. And the way you would get access through it again would be through a target date fund or through a managed account solution. And the reason I don't think it's going to be the case that people will get direct access to these funds, aside from the fact that there's general consensus that it's not a very good idea, is that again, the original opinion letter that Pantheon Ventures partners opinion letter was very clear about the fact that there needed to be an advisor involved, standing between the allocation and the end investor. It's also the case that Paul Atkins, who's the current head of the current head of the SEC, in his congressional testimony and his confirmation hearings, expressed support for that original DOL letter. And again, so I assume that framework will be carried through here.
What about cryptos in a model like yours? Are you planning to change your model to incorporate cryptos at all?
Yeah, we're probably not going to be incorporating cryptos. We do allow investors, if they're holding crypto and they want to get they want to get advice from us. They want to have us manage their portfolios, and they're holding it in some separate account. We will model our allocations around that crypto allocation, but at this point, we're not comfortable making a recommendation to crypto, largely because there's no real way to kind of estimate what the long-term returns on crypto would be. So.
I think people make the distinction between, let's say, an altcoin in the crypto space versus Bitcoin. Not everybody makes that distinction, but that distinction is being made up by a lot of people. And certainly we're seeing Bitcoin treasury companies pop up, not crypto treasury companies pop up. So perhaps Bitcoin may have a role in a portfolio like yours alongside other alts like gold. I'm just speculating here. What do you think?
Bitcoin would be the most likely candidate, but again, that's not something that at this point that we're really entertaining.
When you're looking at alternative assets besides traditional equities and bonds, just maybe walk us through your decision-making criteria and what metrics you look for.
Sure. Well, first of all, we have an underlying kind of statistical model of how these different funds should behave. So the thing we're looking for is, essentially, if you add a particular fund to a mix, is it providing, efficiency to the portfolio? So is it generating enough return and reducing the overall risk of the portfolio such that it's, worth investing in? Things like fees are important because, again, all of our investments are implemented using, mutual funds or ETFs or something called like a separate account product, which is like a mutual fund but is not publicly available. And so essentially, that's what and then, do we expect the vehicle to provide some level of alpha, which means that there may or may not be additional return over above what our risk model would predict that it would return.
What is your view on some statistical asset allocation models like the optimal modern portfolio theory, for example, optimal asset allocation model based on Sharpe ratios and volatility? Does that work in real life?
These are all good. Yeah, these are fantastic tools. I mean, I would I don't think you want to use them in isolation. I think they're a good way to get an initial estimate of how you might want to be invested. But there are a lot of additional statistical tools you can bring to bear that help, kind of enhance that modeling, such as you can do, simulations of different types of portfolios. One of the things we do is that, again, asset liability optimization, in which it's not, it's similar to mean variance optimization, or the Sharpe ratio maximization that you referenced earlier. But the idea is your benchmark is you have another sort of asset that you're trying to optimize to get close to. I think all of these are great tools for an initial estimate of how you want to invest. But I also think it's important for, to bring, there's a lot of information that falls outside of these models. And so I think to the degree that, again, you use them as a tool and not necessarily as the be all and end all, that they're super helpful.
Okay, and then the other part of the article that you wrote, private market funds. What exactly does that mean in the context of a retirement portfolio?
Yeah, that's a good question. So people are talking about, so these are things like private equity and private credit. So these are investments that don't trade on an exchange. They're effectively illiquid, and they're priced via an appraisal method. So they're not priced on, they're not priced by the market. What that means for their inclusion in portfolios is there will never be like a pure sort of private equity fund in a retirement plan. What there will be something called a semi-liquid fund. And what those are, that would be a private market fund that's wrapped in an account that includes a bunch of public market investments as well. So if, for example, I have a real property fund, the real property component is not liquid. But let's say I have 15% of that account is in REITs, and REITs are obviously quite liquid. That would be how the account would be managed. And that's how the investment manager and the manager, like us who was managing the investment managers, get money to and from those portfolios, ensure there's sufficient liquidity to satisfy the needs of a retirement plan, because the cash flow characteristics are very different than they are on the institutional side. All
right, let's talk about the BLS situation regarding the firing of the commissioner of the BLS. Okay. You wrote, every time you reach into your pocket to use your credit card, you indirectly touch the BLS. What do you mean by that statement? And ultimately, how does a change of the commissioner impact the financial lives of the regular person? Yeah,
I mean, I could talk about this forever, but I won't. I'll answer your question. Virtually every business decision that's made is made directly using data from the BLS, or indirectly using that data. So every time you touch it, so for example, interest rates, right? So interest rates, the Fed funds rate is set by the Federal Reserve. And what is one of the key metrics they use? They use the personal consumption expenditure, right? That's how they help decide what they're going to set the Fed funds rate at. If that number is believed to be corrupted by political interests, it's going to be very difficult for the Fed to feel comfortable making making some decision on the Fed funds rate. And then anytime, if you are, if you're hiring people, if you're renting property, if you're, whatever, anytime you have to have an implicit contract or an explicit contract that incorporates the inflation rate, and they all do, whether you know it, whether you do that or not, you're not going to be confident that that data is actually unbiased, or at least that it's not biased by political interest. And so the importance of having a trustworthy organization, organ of the government that essentially is responsible for all this very, very important macroeconomic data is potentially, catastrophic. Now, I don't think that it will necessarily have a bad outcome. And two reasons for that is, one of them is that the current processes that the BLS uses are very, very much sort of baked into the organization. It's not easy to change things. And it would be very hard for somebody who's heading up the BLS to fudge, the data himself. The other thing is I really don't think that the current nominee, E.J. Antoni, is. I think the chance of him making it past confirmation hearings is actually fairly low. If only because I know people have questions his technical ability, but I think that the fact that he's such a obviously partisan and political person, I think could be a real problem for him. So again, he was at the January 6th riots. He's on podcasts of people who are very, very, very pro MAGA, like super pro MAGA. I think all of this is not going to go down very well. And it certainly will not go down well with the market.
Well, what does that mean for data independence if, let's say, you have somebody who is, in your view, kind of partisan? We as investors and observers of the markets, need reliable data at the end of the day.
Yeah. So let me. So the first concern would be, although I actually don't know that the first concern would be is that the data is that somehow he's able to put systems in place that biases the data to make the administration happy. I don't think that that's super likely. I think the likelier scenario, if somebody like him gets confirmed, is that there will be this lingering sense out there, at least for a period of time, that the data is biased, even if it actually isn't. And that sense, that belief that the data is biased, I think is enough to cause problems in the market and cause problems just for the United States. When we go out to the rest of the world seeking, financing for our debt and all that kind of stuff. So it's not a good situation, but it may actually resolve itself and be okay. But it's all about confidence, right? The U.S., we're the leading country, like we're the most powerful country in the world. We're the leading economic power in the world because of confidence in our institutions. And when things happen that underlie that confidence, it could bode poorly for the United States as a whole. So it's a potentially very big deal.
Okay. Just going back and finishing off on asset allocation for retirees. We haven't touched on real estate. Traditionally, most people have had their wealth tied in real estate and REITs. How does that fit into your portfolio allocation?
Well, we do include REITs, and we also and we do in many cases, in cases where they're available, include allocations to non-REIT property as well. So any investment that, the beauty of property is that it gives off a pretty consistent yield, right? And when you're in the retirement phase, being invested in assets that are income oriented and where the return profile is based on dividends as opposed to expected capital appreciation is always a good thing. So property's good.
And that leads to your diversification principle or thesis, if you will. I think you have a pretty interesting approach to this topic. It's a very widely studied academic topic, the topic of diversification. How many assets or securities does one need to hold to be fully diversified, quote unquote? What actually does it mean to be diversified? Do we even need diversification? Some asset managers argue we just need to be concentrated and right most of the time. So, how do you approach this subject?
This was not a good question because I wrote about this pretty extensively about 10 years ago. So the question, the number of assets or stocks you hold does not answer the diversification question. And in fact, what you care about as an investor is not diversification, but rather efficiency.
I don't mean to interrupt you, but you're okay. A lot of people do agree with you, but we were taught in school, I remember in business class, at undergrad, 40 stocks means you're diversified. I don't know where that came from. That was just in a textbook.
Okay, so I've done this experiment, by the way.
Yeah.
It can actually be fewer depending on what market you're talking about. The question is, what is your definition of diversification? So if you want to replicate the S&P 500, you actually don't need that many stocks to have the same performance characteristics to the S&P 500. It could be as low as 20. Sometimes it's 10, depending on what the breadth is of the index. I think the number 40, and it changes depending on what criteria you're using, and whether you're trying to, and what you're defining as a diversification. So if the goal is not to, so I'll give you an example. If the goal is not to essentially replicate a particular index with as few stocks as possible. Diversification, you can probably do less than 40 stocks. I would say it could be something closer to 20, or even less than that if you want to do it. And in this case, the way I'm defining diversification is the point at which you get to risk that does not really change as you add more stocks, or standard deviation that doesn't change as you add more stocks. So in other words, the experiment is I add one stock, what's my standard deviation? I add another stock, what's my standard deviation? And I do that. And at what point do I hit the standard deviation that I would have if I had a market weighted allocation to all of those stocks? And you can do it where you have an equal weighted allocation to all of those stocks, and the number goes up, obviously, but it doesn't really get that big. So I'm sure that's a much longer answer than what you actually wanted. But you don't need that many stocks to be, quote, diversified.
Right. So let's say, okay, I'm planning for retirement, as most people probably are. And I'm thinking, okay, what do I actually need to do to be, I want some return, but I also want to be safe by the time I'm 70 years old and I'm retired. So I own a home. I have a 401k. What else do I need is the answer. There's a question that I'm constantly asking myself in my head. How many assets do I need to buy that are uncorrelated with the broad equities market such that I am properly diversified, quote unquote?
So again, it's unfortunately, it's not a very simple answer, because what you're really looking for, and I think this is a good way to think about it. You're not looking for, quote, diversification. You're looking for efficiency. And you'd mentioned the Sharpe ratio earlier. That's a good way to think about efficiency. I can be very, very diversified and have a portfolio that's really not going to perform very well at all, right? What I want to do is I want to make sure that the diversification minimizes my overall risk, or the overall expected variance of the portfolio, and that the return that I get in the end is actually as good as it can possibly be. So one thing to do is, the question about how many stocks do I need is not really the right question. The question is what kind of stocks do I need to make sure that I'm diversified? So it's a question of making sure that the stocks, the elements that drive the performance of those stocks, right, or the drive the revenues of the companies that those stocks represent, are coming from different places, that the expected performance of these vehicles is going to be kind of sufficiently differentiated. You're in different sectors, you have different names, that you should see a muting of risk through that diversification. So like I said, you can actually get a very diversified portfolio if you're just talking about stocks, probably with 15 stocks out there, if you can do the work and you can do the calculations.
Okay, so again, what exactly do you mean by efficient? How do we achieve this efficiency here?
So efficiency literally means, in this case, I'm defining it again as the Sharpe ratio, or as simply the expected return over the risk of the portfolio. And looking at it from the standpoint of both risk and return is really is critical. So again, just getting a bunch of uncorrelated assets out there without any particular attention to how they might actually perform may get you a very low risk portfolio, but it may not really return very much. And you're investing because you want to make a return. So the act of putting together a portfolio that will have a high expected return for overall risk is, again, maybe this is isn't a great answer. It's actually pretty complicated, but there's methods of doing it. And again, just sort of rule of thumb things are, again, looking for stocks that are in different areas of the market and where there's some expectation, that they'll actually perform pretty well as well. I feel like I'm not really giving you the answer you want. Unfortunately, it is very complicated.
Well, let's just take a look at some maybe metrics that you may use. This is from Morningstar, for example. I'm not sure.
Sure.
I'm not sure exactly what the security is. S&P 500 PR. What is PR? But anyway, this gives a Sharpe ratio of 70.71. Yeah. Go ahead.
So this is only the price return of the S&P 500. It's actually the returns here would be lower than what you would actually get.
Right.
So it's interesting to look at, but you would probably want the entire. So the Sharpe ratio here is saying that the price return, the appreciation on the index on average, is divided by the standard deviation of that index. The variance of the index is 0.71. That's what the ratio is that you wind up with. The interesting thing here is that for a stock portfolio or a stock index, virtually all of your variance is coming from that price variance. So what this number would look like if you actually use the total return index, which says TR instead of PR, is that Sharpe ratio would actually go up because your returns would go up a little bit. However, the denominator, that variance, that standard deviation would barely change at all.
You typically, I think, you want your Sharpe ratio to be as high as possible. That
absolutely,
maximize efficiency. So, do you use the S&P as a benchmark? And let's say, well, you got 0.71. Therefore, the portfolio you design should be more efficient than the S&P. I should be at least 0.71. Is that something you do internally?
Yeah, I think so. The issue with Sharpe ratio is the mathematical fact is that you can have a very low yielding asset with a very low standard deviation. And this comes back to that idea of efficiency. So cash, for example, like the 1 month T-bill has a really high Sharpe ratio, right? And actually now it has a really good return too. But let's go back like 10 years when it had a really crummy return, right? You still had a really high Sharpe ratio. So you need to be, so the Sharpe ratio is a good metric, but it needs to be, again, in the context of not only what is my Sharpe ratio, but what is my expected return as well, and what is my standard deviation as well in that portfolio.
Okay, so I'm going to bring this up as an example. Bitcoin, for example. A lot of Bitcoin proponents have highlighted the fact that over the entire course of Bitcoin's life, it's had a higher Sharpe ratio than any other major asset class, despite its huge volatility. And that's because mathematically its returns have been astronomical relative to its standard deviation. And so Fidelity has put together this research paper dated May 1st, 2024. And I think just skimming through it, the Bitcoin Sharpe ratio between 2000 and 2024 was about 0.9, so slightly higher than the S&P 500s. And yet, maybe as efficient as it is, mathematically, it's not incorporated into a lot of retirement funds. Why not?
Well, I think there are a couple of reasons for that. One of them is that it's just, so first of all, Bitcoin also lost, it had a peak to trough drawdown about a while ago of 75%.
Sure.
So there's a lot of downside potential risk in the portfolio as well. It hasn't shown up that much. It only showed up really in one period significantly. But I think that that's something to be concerned about. The other thing is this is a new asset. It's not really it seems to be priced largely by sentiment. There are no cash flows associated with it. So this really isn't it's not a security. It's not an investment in the sense that you invest in this and you expect some sort of like cash flow the way that you do in basically every other investment that you would invest in, including commodities too, which have they have a return, like a cash-based return. As you're holding them, or a holding return as you're holding those commodities. So it's very, very much sentiment driven. And so I think it's scary for a lot of people. I'm not saying it's a bad investment. Obviously, it's turned out to be extraordinarily well over this time period. But there are a lot of reasons to not go all in on this as well. I would also argue that at the moment, I think because, again, we keep coming back to the current administration, and I sound like I'm like a political pundit, which I'm definitely not, more than anything else. But this desire to make the U.S. the crypto capital of the world, the fact that the Trumps have a lot of financial interest in the crypto, area, are all things that are really contributing to the spectacular, particularly more recent return in these currencies. I think the technology is fascinating, and that there will be a lot more use of crypto and blockchain technology in the capital markets, particularly the public capital markets. But it's risky, and that's why I think the majority of advisors would not really put a big chunk into crypto. Although, again, using it in a small amount does seem to be like a perfectly reasonable thing to do.
It is a relatively new asset class, you're right. It has had huge drawdowns, you're right. I wonder if the same logic could be applied to the large cap stocks in the S&P that are tied to the tech sector. For example, this article that I have on my screen, it makes the comparison between Bitcoin and tech stocks, arguing here that Bitcoin over the last 2 years has been on par in terms of volatility to the largest Mag 7 stocks. And so I wonder how you feel about the Mag 7.
This is not a good comparison. All right. So the Mag 7 are actual companies, right? And you can analyze them, and you can build out an earnings model. And you can use tools that investors and analysts have been using for years to come up with a valuation model of what these stocks should be. That doesn't mean by any means that these models are right or that the market obeys them in any way, but there's a way to kind of get your hands around what one should expect, right? Mm-hmm. Crypto doesn't have any of that stuff. There's really no way of forecasting, certainly intermediate term returns. All the models that I've seen, and I'm not a crypto expert by any means, but all the models I've seen are based on the time series that crypto has produced. And there's not a lot of fundamental, information that you can put in there. So I think that makes it risky, right? And the example of this is the piece you showed. I hadn't seen it before. It's actually really interesting because I think it points to the fact that it points to the risk of really using, they say past performance is no predictor of the future. Sure. And the fact that the information we have on Bitcoin is really limited, if it's limited to fundamentally just the returns that the asset class has produced. And there's not an ability to model it beyond that. And I don't think that there is right now. Then that makes it just very, very risky. So risk is not just variance in return, it's also opacity of information or lack of information.
Broader question then. Yeah, I mean, no. It makes sense. You earlier in the interview, you stated that over the course of someone's life, as they enter retirement, they should you'll allocate fewer risk assets to that individual. Okay, so then, just philosophically speaking, how do you define something that is a risk asset? Certainly, Bitcoin fits in that category, but then could one make the same argument with most of the S&P 500 stocks at this point?
Oh yeah, definitely. So the way we define risk asset is actually pretty much everything that's not everything that's not a bond. So stocks are risk assets, commodity futures are risk assets. Bitcoin, which is a lot closer to commodity into currency, would be a risk asset as well. And then non-risk assets would be asset classes where the sort of the underlying fundamentals of how you get paid in the assets is not that risky. So a government bond, a treasury bond is risky in the sense that, it has price variation, right? And if you have like a 30-year treasury, then the price of that bond is going to move out a lot, but you will definitely get paid. You will definitely get your money. So risk assets, though, I think a good way to think about it is that as I move from, if I think of some entity that's collecting revenue to then pay through the security, right? The ultimate taxing authority and the ultimate, king of all revenue collectors is the U.S. government. Okay, as you move down to, let's say, municipalities, you're talking about municipal bonds, and then you move into individual companies, and then you move from the debt of companies to the equity of companies. You're moving down the capital structure. Then the assets become more risky, and they become more risky because there's more risk around whether you're actually going to get your money or you're going to get paid or not.
The statement that risk is not just standard deviation in volatility, which is something you mentioned previously. That's something some other people have said as well. Is that true? It is true. How do we look at risk? Yeah.
So if you have to step back and say, give me the broadest definition of risk of what that is. Risk is basically essentially the quality of your information. How good is your information? And so the reason why, and what is your ability to make some sort of assessment of how a particular asset might perform? So as my information gets poorer, the risk essentially goes up, right? So the reason why stocks have higher standard deviation than bonds is because the certainty of me getting paid by a stock, of me getting a dividend on that stock, is actually lower than it would be for, let's say, a bond issued by the same institution where the bond sits higher in the capital structure. Okay, so my information, there's risk there because I actually don't know what the company's revenues are going to be in 3 years, and maybe something bad will happen and they won't pay out a dividend, and all that kind of stuff might happen. The likelihood, my information that I'm not going to get paid out if I'm holding a bond, it is better because I know that I will get paid before the equity holders get paid. So there's a lot of different ways to describe that, but risk is essentially the quality of your information, and how your ability to synthesize that information into something that actually means something.
Okay. Very good. Thank you very much, Hal. Let's close
Sure.
off here, and we can let people study your work in more detail. Where can we go to read more from you, Hal?
That's a good question. Well, I have a few things right up on Morningstar.com, and I do have a new piece coming out that's going to be talking a little bit more about the opinion letter from the DOL. That's going to be, it's a short piece. It's pretty easy to read. You can read it in one sitting, but kind of focusing on the idea that like alts is not an asset class. The DOL letter talked about allowing alts, into 401k plan. Again, we think that's generally a pretty good idea, but alts is not like, it's a lot of stuff that everybody just kind of put under one umbrella. Bitcoin is an alt and private equity is an alt. And there are no two investments that I can think of that are more different than each other than Bitcoin and alts, right? Bitcoin, again, there's no cash flows associated with
markets.
Private markets, yeah, I'm sorry. Whereas a private markets is kind of the most traditional type of investing out there. You're investing in a company, you're lending to a company, you have a definite expected cash flow. Again, it's not priced by the market, so you don't always know exactly what the valuations are. You always know exactly what Bitcoin is trading at because it just traded. So they're really different from each other, and yet they're all being kind of considered to be alt. So part of the piece that I'm talking about is sort of addressing that issue.
Thanks again. We'll put the link down below to Morningstar, and we'll speak again. Hal, take care for now.
Yeah, thanks a lot. Take care. Bye-bye.
Thank you for watching. Don't forget to like and subscribe.